What is quarterly theory? Quarterly theory is simply a way of organizing time and price into 4 repeating phases: the setup, the trap, the expansion, and the exhaustion. It's not a prediction tool again, it's a framework that helps you read any chart more clearly, whether you're looking at a year, a month, a week, or even a single day. It's about structure and the timing. So again, right here, when we talk about quarters, we are talking about 4 equal parts of some certain thing, whether it's a bottle, a book, a tree, a tomato, whatever you can look at. So it's point A to point B. If we divide that in half, we get our 2 separate points, which is 50% and 50%. But if we then divide those 50% into halves as well, we now get 4 equal parts. So now again, we are looking at time here as point A to point B for us. And if you look at the left side of your screen here, you can see the yearly cycle has Q1, Q2, Q3, Q4. The monthly cycle has Q1, Q2, Q3, Q4. The weekly cycle has Q1, Q2, Q3, Q4. The daily cycle has Q1, Q2, Q3, Q4. The 90-minute cycles have Q1, Q2, Q3, and your Q4. So this here is our Q1, which is our point A. Our Q4 is our point B, which is the full range. So it's not about a certain time frame. It's about looking at this as a way of organizing, not as a way of you saying, I'm gonna use this to predict. It helps you predict after you organize. So that is what you want to do first. You want to know that this is an organizing tool that shows you where your first quarters are, your second quarters, your third quarters, your fourth quarters at a specific point. So if we add a 1 minute cycle here, that means we're gonna have 15 times 4, and we get our 1 minute, which is 60 seconds. So this applies to every time frame: the year, the season, the day, the month, the week, and any frame you want to be looking at. So a 4-hour candlestick has 4 quarters as well, which is 1 hour each. Each candlestick in the 4-hour time frame has 4 1-hour candle. That makes it what we are talking about here, quarters. So since time is fractal here, each level reflects the others, and a year has Q1 through Q4. But this is one full thing. It's a full year. When we end up looking at this, we end up saying 1 year. We don't say a year that had January, March, April, May, June, and a year that had October. We just say it was 1 year when it's complete. Why? Because it's a full cycle now. So this is us dividing the year or every cycle into 4 equal parts. So since this year has 12 months, we divide that by 4, we get 3, 3, 3, 3, and then that's our single quarter. Each and every single quarter has 3 months in the year cycle. In the monthly cycle, we get our quarters being 1 week each, which gives us the 4 weeks of the month. Our weekly cycle, we have our Monday, first quarter, Tuesday, second quarter, Wednesday, third quarter, Thursday and Friday, our fourth quarter. Or you can simply just look at Thursday here. And then our daily cycle now has our 6 hours, 6 hours, 6 hours, because it's 24 hours divided by 4. We now get 6 hours each. And then now this leads us to what? To our sessions. And then our 90 minutes. So this right here, this 90 minutes cycle, the reason I added it here is because I wanted to show you here that in each and every quarter here, this Q1 on its own is also its own full cycle, because it's also point A to point B right here. So point A to point B here for the full year, but point A to point B for the full quarter. So right here, since we have this 6 hours, 6 hours, 6 hours, 6 hours, if we go and divide this 6 hours by 4, we now get our what? Our 90 minutes. And then if we go deeper into those quarters that we would have made in there, we end up getting this 22.5 minutes. 22.5 minutes makes our 45 minutes, and the two other 45 minutes make up one 90-minute cycle. So even this here is inside this here. This is just simply this, and then this here is simply this, because every weekly cycle here we are making a quarter of a monthly cycle, and then this is building up this. So they are intertwined, we can say. And even a single trading week follows the same structure here. Your Monday, so your Monday here, again, you want to look at your Q1s. That's what you want to do here. So your Q1s in each and every cycle are important. Please write that down. You will need this later on, and backtest it as well, and you see what I'm talking about. Don't just take it from me here. Go into your charts and you see what I'm talking about. It will actually prove itself to you. So your Q1s here, or your first quarters, are very important because they set the range, they set the stage they're gonna be playing on. It's the initial liquidities that are created for each and every cycle. So the initial liquidity here, the high and low, the first initial ones where we wanna be selling above those highs or buying below those lows, we wanna be using the Q1 ranges. So your January to March is your Q1 range that you wanna look at. Your first week of the month is Q1 range you wanna look at for the monthly cycle. Your weekly cycle, this is important. Monday, that's Q1 of the week. Your Asian session, the first 6 hours of your daily cycle, that's Q1 of the day. So these levels give you like information on how if you're looking at the Q1 from the year, it will give you information on how the year will play out. If you're looking at the first quarter of the month, it will give you data for the next 3 quarters of the month, which are the next 3 weeks of the month. And then if you're looking at Monday always gives you data for Tuesday, Wednesday, Thursday, and Friday. So if you want something that repeats every single week, you simply now start looking at Monday, because Monday will tell you what's going to happen for Tuesday, Wednesday, Thursday, and Friday. And then you can now start including the daily cycles and even the 90-minute cycles. And better yet, if you have the yearly cycle and the monthly cycle as your bigger time frame view, that can help you in the long run. So this repeats every day, and trust me, it's every day. So right here we want to look at the importance of Q1. So quarterly theory breaks every cycle into 4 parts again, and your Q1 is your setup. So this is the data that they give you on how much the first prices are. So if it was cheap, or if it made a low in Q1 and made a high in Q1, those highs in Q1, whatever Q1 you are looking at, whatever quarter you are looking at, as long as it's Q1, whether it's the daily quarter, monthly quarter, your 6-hour quarters, or your 90 minutes quarters, let me say. So that is totally up to you on which frame you want to be looking at. But your Q1 here is the accumulation, your second quarter is the manipulation, your third quarter is the distribution, your fourth quarter is the continuation or reversal. So this is the basis of quarterly theory, the AMD pattern: accumulation, manipulation, distribution, or simply the power of 3 is what we are looking at here. So the first quarter is the setup. That's the data that you'll be given to read out whatever cycle you're gonna be looking at, whether it's the yearly, monthly, weekly, daily, or 90-minute cycle. So your second quarter is the trap, your manipulation, your third quarter is expansion, your distribution, your fourth quarter is your exhaustion, which is your reversal or a continuation maybe. And smart money sets up the game on the first quarter. Like, I keep repeating it, and I'm gonna keep repeating it because you need to hear it again. Smart money sets up the game on the first quarter. The high and low of the Q1 or the first quarter becomes the true range for the rest of the cycle. So from point A to B is what we're looking at again. So if it's the year, the first 3 months of the year are gonna give you data for the rest of the year. Everything that follows reacts to that range, meaning maybe, let's say for example, price opens up in April and then it goes above those initial first 3 months highs, and then you start seeing a move lower, and then above 50% of that range you see some sort of what can I say, like a retest above 50% and then shoot lower, going to the lows that were created again in the first quarter. So that's how it may react to it. And again, here's the Q1 logic or the first quarter logic. So smart money sets up the game on the first quarter here. The high and low becomes the true range for the rest of the cycle. So whatever cycle you are looking at, that's why I didn't highlight what this is, but I'm only highlighting the Q1 logic because it applies to every logic. So you wanna go mark up your range, your 50% levels as well of those Q1 ranges, and then you set them up for the rest of the cycle. So this is like you are predicting now. After you have this as a tool, you are now able to predict where you can find cheap prices and low prices. Why? Because you looked at the first 3 quarters again. That's why ICT says leave the first 3 quarters, leave Monday, the first week of the month and stuff like that. So that week, that Monday, that Asian session, that first 3 months of the year, first week of the month, that range, you can set it after it's created. Put on the highs, put on the lowest low in that Q1 range. So whatever range it is, as long as it's Q1, whatever cycle it is, as long as it's the Q1 of that cycle, and then it's gonna let you know where to buy and where to sell. So what happened here in Q2 was we saw a shoot down or a decline down below 50% of this whole range from low to high. This is below 50%. Cheap prices, it's in a discount. Then we start seeing a move higher. The third quarter here makes the move higher above the second quarter while it's above the initial highs. So not only is price expensive because it's above the first quarter, it's also above the previous quarter's high. And then you see this move lower here. And then what I was talking about is this reversal back into above 50%, then the move lower below that low here. We now start see this move lower. So we expand from that range, revert back to it, or we sweep it back for liquidity. So sometimes what happens is it goes higher like this, and then it comes back below 50%, and then it starts going higher instead of going lower like this. So you find the continuation, or you find the reversal here in Q4. So these are your entries, levels here, your entries, your traps, and also your buyers as well, depending on where you are in a specific quarter. That is after the first quarter of whatever cycle you are looking at. So remember here we spoke about AMDX. I think that was the second video I posted on this channel. I'm gonna leave a link. If you look right now on the top right of the screen, I'm gonna leave a link to that video. We spoke about this, which is the accumulation, manipulation, distribution, expansion. I also have another video which is the Asian session range explained, and this video is titled how I learned 6 things I learned, something like that. You'll see it pop up on top just now right here. So what I was talking about here in the previous slide is the very same thing right in this slide, but we find now our accumulation in our first quarter, our manipulation in the second quarter, our distribution in the third quarter, and our continuation or reversal in the fourth quarter. So Q1 is where accumulation or manipulation happens, but I want you to look at it as accumulation only. As time goes, you'll notice that sometimes it doesn't get to manipulate lower or manipulate below 50%, but use this high here to continue higher, and it will simply be going higher for these other quarters right here. So again, these ranges here, that's where smart money gets to work early, because they know where cheap prices are. Cheap prices again are below 50%, below this low, and sometimes it can be this high while it's below 50% or below a low of a bigger cycle Q1 range, because it's fractal. So remember that Now I want us to look at the weekly flow with the first quarter logic. So how the day, each and every single day will go based on Q1, which is Monday here. So when we are mapping out the week using this Q1 logic that says map out the range highs and lows, our Monday for the week is the setup, Tuesday is the trap, Wednesday is the expansion, Thursday and Fridays are Q4, which are rebalance or reversing. So this fractal plays out with precision throughout all cycles, not just the week, how I'm gonna explain it here. So sometimes you get, again, your Monday range being created, and instead of Tuesday being higher than this Monday high, it's above 50% of that initial range created. Then we see higher prices created here, and then we see cheaper prices. Below that Monday and below Tuesday, we see Wednesday also making its move higher back to the to the Monday low. And then Thursday or Friday, Thursday maybe we might see a move lower, retracing back, and then shoot back higher later on, going above that Monday low. And then Friday we get something like this below that Monday low just a bit, or as long as it's below 50% of this, it's still providing cheaper prices, we can get a move higher like this. But sometimes it's not this situation, it's a situation like this, where you find your second quarter now starts below 50%, finds the move higher. Now this is providing expensive prices that are expensive than the initial liquidity created for the week. Why? Because Monday is the first quarter of the week, so it's the data that we're gonna have for the week. It's always gonna play out by these levels below 50%, above 50% sells, below 50% buys, above the highs sell, below the lows buys. It's gonna do that always in each and every cycle. It's not gonna care which cycle it is. So again, we want to look at the multi-range flow here. So our Q1 range, this doesn't stop at the week only, where we're looking at our Monday highs and Monday lows. So the first 3 months of the year, which is January to March, that's our first quarter. The first week of the month is our first quarter as well. The first day of the week, which is Monday, was what I was showing back then, that your Mondays, every single Monday, gives you data for how the week is gonna play out. You are now able to determine if price is expensive or cheap during the week using Monday's range. So this same pattern applies right here. The range is created, then we sweep, then we expand. Range created. So let's say this is a whole month right here. First week right here will accumulate, second week go below 50% of the first week, and then we see a move higher. So this is 1 week right here in this whole quarter here. And then we see the third week above the second week quarter, and we see the move below. Why? Because it's expensive than the first initial lows created, and it's above the previous quarter's highs, and then we see this move lower. above 50% right here. That's when we see this here on the 4th week, and then it continues lower, and then by the end of this 4th week or at the end of the month, you start seeing a retracement back in. So right here, this is a daily cycle right here, meaning each and every one of these quarters are now sessions. So this is your Asian session, your accumulation. You find your lows, your highs, your 50%. Above 50%, you wanna be a seller. Above 50% always, you wanna be a seller above the highs, and sometimes you can be a seller exactly on the low, and you can buy below 50% below the low, or sometimes you can buy exactly on the high if it breaks out and retests, leaving a PDRA here and then continuing higher. So if you look at what happened here, it was above 50% of the Asian session in the London session, then we saw this move higher. In the New York session, it was below the Asian session, providing cheap prices than the cheap prices provided at the beginning of the day. So the initial liquidity, we can say, and then we see this price now getting much more expensive. Why? Because it's cheaper than these lows right here. So this is a bonus right here because it's now cheaper than the London as well. So you can be saying, okay, it's cheaper than what I wanted to see it cheaper than for me to be able to sell, and it's also cheaper than the previous quarter. This can be some added confluence, and then you see this move higher. In the New York PM session, you can see this reversal from this low and then continuation higher. But this very same thing right here can be applied to this, because the difference is just that some takes longer, some takes a shorter period of time, but the ones that take a short period of time are making up the ones that take longer to be created. So it's simply a fractal. They are creating each other.